Acquisitions, more often than not, can take various creative and imaginative forms. Let's go through one form of acquisitions which have been popular in the last few decades, which is leverage buyout. So, what is leverage buyout? A leverage buyout is an acquisition that uses a significant amount of borrowed money. Can be bonds or loans. To meet the cost of acquisition. These transactions typically occur when a private equity firm borrows as much as they can from a variety of lenders, usually up to 70 or 80% of the purchase price, and funds the balance with their own equity. Because of this high debt-to-equity ratio, the bonds issued in the buyout are usually not investment grade and are referred to as junk bonds. One example of the largest leveraged buyouts in U.S. history is when LBO firm KKR acquired RJR Nabisco for $25 billion. Buyouts are conducted for three main reasons. First is to take a public company private. If you run a publicly traded company, you can use a leveraged buyout to consolidate the public shares and transfer them to a private investor who takes the shares off the market. Companies usually take themselves off the public market to get away from public scrutiny, so that they can focus on solely improving the company's operational and underlying performances. Second reason for an LBO would be to break up a large company. Some companies grow so large and inefficient that it becomes more profitable for a buyer to use a leveraged buyout to break it up and sell it as a series of smaller companies. This can be done by spinning off a portion of an existing business by selling it to a buyout firm. The third reason would be to improve an underperforming company. If an investor believes your company could eventually be worth much more than it is currently, a leveraged buyout could be a good option. The investor would assume the debt with the belief that holding onto the company for a certain amount of time will increase its value and allow him to pay off the debt and make a profit. Why do PE firms use so much leverage? Simply put, the use of leverage or debt enhances expected returns to the private equity firm. By putting in as little of their own money as possible, PE firms can achieve a larger return, while leverage increases equity returns. The drawback is that it also increases risk by strapping multiple tranches of debt onto an operating company. If the operating company's cash flow is tight, and the economy of the company experiences a downturn, the company may not be able to service the debt and will have to restructure, most likely wiping out all returns to the equity sponsor. Leveraged buyouts have had an infamous history, especially in the 1980s, when several prominent buyouts led to the eventual bankruptcy of the acquired companies. This was mainly due to the fact that the leverage ratio was nearly 100%, and the interest payments were so large that the company's operating cash flows were unable to meet the obligation. Hence, attractive LBO candidates typically have strong, dependable operating cash flows, well-established product lines, strong management teams, and viable exit strategies, so that the acquirer can realize gains. I also want to introduce you another form of buyout called management buyout, or MBO. Is a transaction where a company's management team purchases the assets and operations of the business they manage. The financing required for an MBO is often quite substantial and is usually a combination of debt and equity that is derived from the buyers, financiers, and sometimes the seller. The amount of debt taken is typically smaller than the debt taken during an LBO. MBO is one of the ways a company can go private, so that it can streamline operations and improve profitability away from the public eye, and then go public at a much higher valuation down the road. A MBO is appealing to professional managers because of the greater potential rewards and control from being owners of the business rather than employees. However, there are several drawbacks to the MBO structure as well. While the management team can reap the rewards of ownership, they have to make the transition from being employees to owners, which requires a change in mindset from managerial to entrepreneurial. Not all managers may be successful in making this transition. Also, the seller may not realize the best price for the asset sale in a MBO. If the existing management team is a serious bidder for the assets or operations being divested, the managers have a potential conflict of interest. That is, they could downplay or deliberately sabotage the future prospects of the assets that are for sale to buy them at a relatively low price. Do note that a MBO stands in contrast to a management buy-in, where an external management team acquires a company and replaces the existing management.